Hi, Brandon Davis with Davis CPA Group again. I want to talk to you all about LLC, limited liability companies. We've talked before about different types of entity structures, and I want to talk a little bit more in depth about limited liability companies. So a limited liability company, which is an LLC, is an entity that is created whenever you're starting a business. It's one of the entity selection options that you have, and it's used basically to isolate some of the liability you have as being a business owner. A lot of people start off a business, particularly a small business, as a sole proprietorship, meaning that they're the sole owner. My name is Brandon Davis, and if I'm going to create, Brandon Davis's carpet cleaning, and I open up a business checking account, a local bank, and I get some business cards from the website or from the internet, and develop a little website, start doing business under my personal name and my personal tax ID number, which is my social security number. I'm a sole proprietor. So when I go in and I do that carpet cleaning business and I take care of my customers, any positive thing is reflected on me personally, and any negative thing that might happen, maybe I ruin someone's carpet, well, that liability would then fall on me also. Well, a limited liability company allows you to take that liability exposure that you have personally and kind of put a box around it. And so you're creating a separate legal entity, separate from yourself, to have its own identity. And it's called, again, a limited liability company. So I may call myself, Brandon's Carpet Cleaning. Should have used a smaller name, huh? LLC, meaning limited liability company. And so once I create my entity now, I've basically told the world by filing some paperwork with the Secretary of State's office, which an attorney will help you do that. Once I file that paperwork to create the LLC, I've now put a box around the liabilities, and my business is inside this box. And I own the box. I own the LLC. So I'm up here, here's me, and I own 100% of this box called an LLC. And you may be thinking, well, that's great. What has that done for me? Well, it's protected you a little bit. It's giving you some liability protections. But one of the things I want to talk about as a CPA is some of the tax implications of what we just done here. I talked about before, before I set up the LLC, if I had just Brandon's carpet cleaning business and I was the sole owner of it and I was the sole proprietor, well, I'm taxed as a sole proprietor on my personal tax return, which means I file a Schedule C, which is a schedule we put. You report all your business and income and expenses, a part of your personal tax return. It's very simple, it's straightforward, and it works very well. The issue there, though, is 100% of my net profits on this Schedule C are subject to what's called self-employment taxes. I want to write that down. We've got self-employment here because it's self-employed income. So I'm going to have self-employment taxes. And that self-employment tax rate, and I'm just going to kind of make it easy or simple for us, is 15.3%. Okay? And so that's kind of a lot, and that's in addition to the income taxes that I would be paying on those net earnings also, which again are part of my personal tax return. Well, if I create this LLC and it's a small business and I'm 100% owner, the default treatment of that for tax purposes is a sole proprietorship. Basically, for tax purposes, I've not done anything different by creating this LLC because it's what's called a disregard entity from the IRS's standpoint. I'm going to write that down again, a disregard entity. Disregarded entity. And so I've got to do something about that if I want to make a difference. So one of the things you can do with an LLC, and one of the things I like about LLCs, is their flexibility from a tax perspective. I can take that LLC that was a sole proprietorship when I started, and I can make an election with the IRS called a Subchapter S election or entity classification election and change from being taxed as an LLC, taxed as a sole proprietorship, to be an LLC taxed as a corporation. And then I can take that corporation a step further and make it what's called an S corporation. Well, you may be asking, well, why do I want to do that? Well, there may be some tax advantages in accomplishing that. Now, there's some caveats that play into it, and I'm simplifying, some of the things to get us from point A to point B to show you some examples here. So there's definitely some things you want to talk about relative making sure you have maybe employees or other ways to leverage, your earning power in the business. But say I get to the point where I've grown my carpet cleaning business, and I got 2 employees I'm paying, and they're out cleaning carpets, and I'm making a return on my investment in those employees. Well, then I might have an argument to say, you know what, maybe I should be an S corporation. Maybe I should be an S corporation and I should be an employee of this S corporation. Well, you may be asking, well, what's that going to do for me? Well, what it does is now I got me out here, 100% owner of this LLC, and I got this box. Well, this box now is a separate entity for tax purposes. So if I file what's called a Form 2553 with the IRS, and we don't have to get into the details of that, it's something I can help you with. We file that form with the IRS, we make an election to be treated as an S corporation. So now my box becomes an S corporation, and it's its own tax return now. It's called an 1120S. Well, the beauty behind the 1120S now is I have those same revenues and same expenses that I was reporting on my Schedule C as part of my personal tax return. I'm going to take those, I'm going to put them on this schedule, this 1120S form. Well, the 1120S, the S corporation tax return, does not does not pay its own income taxes. It just files its own tax return. Well, you might be asking, well, how does it pay tax then? Well, here's what happens. At the end of the year, when we file your 1120S tax return, we figure out all your income and all your expenses. So we get your income, we got your expenses, and we have a net figure down here. Well, it kicks out another schedule called a Schedule K1. I may be getting a little bit low here, but a Schedule K1 that goes back into your personal tax return. So I'm up here with my 1040 tax return, which is my personal form, and I have my 1120S return that I filed with the IRS, and my K1 that tells me how much to report an income on my personal return would be the net profits. And so you'd have the same net profits basically on the Schedule C versus the S corporation. But you may be asking, well, how am I saving any taxes here? Here's how it works. One catch that you have to have in an S corporation structure is now that I'm the owner, I've got to pay myself a wage. And it's got to be a reasonable wage in the IRS's eyes, and that's something we can work through as well if you decide you want to go down that road. But what happens here, let's say, for example, let's kind of make some room over here. Let's say, for example, that my net profit when I was a Schedule C business, that sole proprietor, was $100,000. Just keep it simple. And I pay payroll taxes on the $100,000 of 15.3%, which is basically $15,000 in payroll taxes, or self-employment taxes rather. Well, if I have employees to help me make that $100,000, I'm not sure why I put a comma there. I guess I was going to write the zeros, but didn't. So if I have employees that help me generate my net $100,000 in profits, and I decide to be an S corporation, I got to pay myself a wage. So here's what happens. So in the S corp structure, I've got my $100,000 in profits, which would be before I pay myself. Let's say we were able to pay ourselves a $50,000 wage. So we have $50K in wages that we pay ourselves. That would go back to our W-2. We get W-2 and go on our personal return. And so that leaves $50,000 in net profits on our S corporation. Again, that we kick down as K1 and come back to us personally. So we're still picking up the same $100,000 of income, either via Schedule C on our personal return as a sole proprietor, or as an S corp owner. So we'd have $50,000 in profits on the business and $50,000 in wages paid back to me as the owner. So income tax wise, I'm the same. Here's where the savings comes in. On wages, I pay payroll taxes. Well, the payroll taxes is that same 15.3% that you would have to pay in the self-employment taxes up here. Well, you can already see if I pay 15.3% on $50,000, that's a lot better than 15.3% on $100,000. A little over $7,000 in tax savings just in those self-employment and payroll taxes. Now again, there's things we've got to look at to make sure the structure is appropriate, but this is one idea or one thing to think about as your business grows and utilizing an LLC and an S corp structure to save some taxes. Happy to talk about that further. Reach out to us, give us a call, and we can help you make the right decisions.